In the world of commodities, let's take a look at what exactly went by in the week gone by. First up, NSE's gold and silver prices seem to be recuperating some lost ground. As you can see on your screens, NSE silver is above 38,000. NSE gold as well is once again reclaimed the 32,000 mark, so good going over there. However, when it comes to the base metal complex, or for that matter, just the overall macroeconomic environment that we are staring at, which would of course have its impact on metal prices, it's not all that hunky-dory. First up, I'm going to address the news, and that is with respect to global growth forecasts. Like our first headline said, from China to Europe, the warning bells have been rung. First up, we had China, of course, in the beginning of the week saying that they're cutting their growth forecast for 2019 from 6.5%, a very decisive 6.5%, to a range of 6 to 6.5%. Then we had Europe, ECB, just yesterday saying, or rather flagging off that there are significant growth concerns. And of course, you do have Brexit as well to add on to their troubles. So they believe that the growth in 2019 is only going to be 1.1%. This versus their earlier estimates of 1.7%. And finally, then we had the OECD that as well cut their global growth guidance for 2019 from 3.5% to 3.3%. So like I said, world over, the warning bells are being rung. Of course, not to mention OECD's, warning comes after the IMF had already cut their global growth forecast approximately a month ago. Now, let's take a look at LME's, the LME prices for the week gone by. They also, in fact, by the way, reacted to the China trade data. But yeah, as you can see on your screens, aluminium was down 2.5%, copper down 1.3%. We also had that added pressure of inventories rising in, in most of these metal counters. So that as well did put pressure, because up until now it was the fact that, hey, inventories are still lower, so that could perhaps provide some support to metal prices, but I think that as well seems to be abating. It was only nickel, interestingly, that once again managed to stand out very smartly in the week gone by. The China trade data, meantime, as well, once again disappointed, with the February exports falling more than 20% versus an expectation of a fall of just 4.8%, whereas imports too declined 5.2% versus expectations of a fall of 1.4%. Even iron ore imports were in fact at a 10-month low. Of course, you have to also attribute it to the fact that February is when China enjoys their one-week-long Lunar New Year break rather. So that as well is something that you must take into consideration. But on a year-on-year basis, definitely the drop has been worse than expected. So let's discuss all of this and more. And of course, more importantly, what's the impact on metal prices, on the commodity complex, with Peter McGuire, the Chief Executive Officer of XM Australia. Peter, it's always a pleasure having you with us. In fact, you're joining us right here from our Mumbai studio. So thanks so much for taking out time. I'm going to start off first with a warning given by the Chinese government. They've come out, they've acknowledged the fact that trade war, domestic weakness as well is hurting the country, and that consumption and investment growth is slowing. Has the commodity complex, however, already absorbed all that information?
I don't necessarily think they've absorbed it, but it's been a very, very volatile time if you're looking over the last 4 to 5 months. If you take, for example, what's happened as far as that crude oil sell-off that we experienced in latter part of September, October, November, and then leading into Christmas, was such a huge sell-off, and it took so many markets down. Gold had a run up, but there was a time that I think that created great degree of uncertainty. And is there a deal to be done? President Trump came out and really pushed forward to try and get some deal satisfied and to the market to really take a little bit of a rebound. And the markets in some way are building a little bit of hope in there, that we've seen January and February as a very solid uptick for both equity markets in China and of course the commodity complex.
You know, a part of the Chinese stimulus that many were waiting for has come through. They've announced lower taxes, especially for the VAT. They've announced higher infra spends. But would this be essentially enough to sort of cause a rebound of sorts in metal prices?
Well, I think the demand picture as far as, infrastructure spend and, more construction, and that's really where China's been an envy across the world. So many countries are realising that, what they've been able to achieve in those, the last 20 to 30 years has been breathtaking. And the demand picture, as far as coal consumption, as far as energy, is only growing. So, electrification of the nation, diesel consumption, fuel consumption, foods, everything is just a one-way traffic, and you're going to see probably in a lot of ways further consumption growth and the demand picture is looking fairly strong over the coming years. Population base, and of course internally the country is becoming far more satisfying its own needs and wants, with demand picture is just increasing. So it's a very, very solid, I think, picture over the coming years for China's consumption.
How much of a worry would global growth slowdown be for metal prices? I mean, China, Europe, OECD as well has cut forecasts for the global economy. Do you think that could have significant impact on demand for the commodity complex?
When you're thinking, and that really needs to, I think, absorbed. Many people were saying that, 19, are we going to see that the growth engines remain strong? And, the middle part of last year, there were many analysts saying that 19 wasn't going to be a bad year. Well, those reviews, and they've been the forecasted cuts. We're now looking at, the European region being very, very slow. And that's being a contagion that's going across many of those different markets, emerging markets as well. So it needs to, I think, just take on board, are we going to see as far as rate cuts, what's happening from a demand picture, what happens as far as uncertainty in markets, the three great handbrakes at the moment, what's happening as far as US and North Korea, what's happening as far as the Brexit issues, and China and trade with the US. So that degree of uncertainty is really creating, I think, a lot of a very hard picture to see where we actually are putting our feet to the ground.
Okay, you briefly alluded to the US-China war, and it's definitely managed to hurt both economies. But many say that there's a lag. So the latter part of the year perhaps should be searched for evidence that perhaps the Chinese economy rather has stabilized. Would you agree with that thought?
Well, if we look at the US for a test case, this time last year we're saying, well, they're going to see 3 or 4 rate rises in 19. Now you're sitting at this time of the year and you're saying, well, you might see 1. Some analysts are saying, well, we'll see 0 as far as, rate rises for 2019. As far as the Chinese situation, we've seen a very strong push since the Lunar New Year for Chinese equities. The market has rebounded incredibly well over the last, say, 6 weeks in China, and probably even 8 weeks. It's been, one-way traffic all the way since Christmas. Moving forward, it's hard to determine, where we're going to see. Are we going to see a market consolidate at these points, profit taking? There's just so many moving parts, but any market that moves up so quickly probably will see a little bit of profit taking, and that won't be unusual for any market that gets exhausted in its moves to the upside.
While there's enough hue and cry on the demand side, would the supply side worries help perhaps support metal prices? Because inventory levels have fallen quite a bit. Of course, there's been a rebound last week, no doubt. But yeah, in general, inventory levels are low, and supply as well in many geographies is currently in a limbo. So do you think that could perhaps support metal prices?
Well, as far as the metal prices, I mean, many of those markets were sold heavily down, and it's a time of reconsolidation and probably restocking of inventories. You'll see that pretty much going into 19, so that's not unusual, and it's cheaper buying compared to what you saw, years previous. So I think that as far as the demand picture, you'll see a strong buying over the next 3 to 4 months leading into that European northern summer. And it's not unusual for markets to just take a little bit of a break, run down inventories, and now you're looking at a restocking phase.
Okay, so Peter, just to sort of summarize the conversation that we've had, what's your overall take then on the commodity complex? Which commodity also stands out as best placed for 2019?
I think a couple of weeks ago you would have seen the gold market as possibly, edging to that 1350, 1370 number. Well, it was been heavily sold off, but probably a degree of profit taking. The US dollar's had a strong move to the upside in the last 2 weeks, so that needs to be also considered. And then the crude market, it's been absolutely one-way traffic since December 27, December 28. The crude market's bounced very, very strongly to the upside. So we've got a meeting in Baku, Azerbaijan. I'm attending that on the 18th of March. And that meeting, I think, is going to be one of, let's see, take a deep breath and realise what markets have moved. So I think I'd take a close eye as far as crude market over the next 2 to 3 months. I think there could be further push to the upside, but the degree of uncertainty is the Brexit issues, what's happening as far as China and US trade, and the North Korea situation.
All right, Peter, we leave it at that. It's always a pleasure catching up with you. Thanks so much for joining in and, of course, joining us right here in ET Now's Mumbai studios.